I wanted to discuss some strategies I use for looking up names, finding trade ideas, waiting for the fat pitches, not trying to force trades, and going over some examples in how these trades kind of played out. And so one thing I want to do is give a kind of quick update on some changes to the site. I have this has spread screener option implemented. And what you can do is you can say, does the equity have a gamma spread? What that means is, let me run the screener, change it to gamma, right here, this is the stat, we want to see gamma, and the spread is basically the largest put and the largest call. That's what I have here is the call in purple. Right click, settings, you can see largest call, largest put, see that? Those have to be on the same expiration. And so that's what I call the spread here. And the expectation is that the price, if it's longer dated, the better. But it will trade within that range. Now, that's not a science. It's not a guarantee. These things change every day, right? But what I've noticed is that the longer the term on the spread, you see how this one's short term, this is two days, that one's probably going to be less relevant, right? But longer term ones, let's check out Reddit. Longer term ones, let's go back here. This is probably more of an open interest spread than anything. Yeah, so here you could see, here's the puts, here's the calls, right? And the expectation here is relative to general market volatility. What I mean by this is that when you have suppression of volatility over a month or 2 months, you have to have, a lot of time here with the suppression of vol. It can't just be one day, right? You have to look over a time horizon. Let me go back here. Let me go to max. So here's suppression of vol suppressing overall in the market, S&P 500. Then it flatlines here for about a month and a half, maybe up 2 months. And then it picks up again, compresses, picks up again, compresses, right? And then if I go forward in time, it picked up again. You see? So when volatility has been compressing and compressing and compressing and is trending upwards or just kind of stagnant, it's not really pushing lower and lower and lower. One way to see this is that there's this undercurve. Do you see this undercurve? That's pretty common. You kind of see this undercurve, right? Undercurve, kind of little undercurve there. That's pretty common to see, this kind of undercurve. You can see it kind of extends all the way over to here. And now we're in a new regime. See that? But when volatility is suppressed, what we're looking for are ideas. Let me go back. What we're looking for is ideas where you have long-term spreads, whether it's an open interest spread, gamma, delta, whatever, just some long-term spread. I found that the long-term open interest ones are really great. You can see there's the delta is still there. I don't think the gamma is going to be there, but let's see. No, it's not showing the gamma. Mostly you get this upfront gamma just because price is sitting at that level and gamma is much more stronger right there at the money. So typically you won't see this one over here, but it's fairly large. Another way is you can look at the bar like this, and this is basically this chart here, but compressed all into one strike, right? So it's just based on the strike. It's not based on time. If you wanted to base it on time, you could change these options up here. And so I'll go through that as I walk through things. So this is a trade I had on. I kind of fucked up the positioning, but hey, it's part of trading. But so I saw this here, this long-term spread. Now, here's another point, is that what I found is the longer term the spread is, the higher the error rate around the pin. What I mean by this is, let me get some drawing tools here. So these ones are out till what, January next year, I think? Is that what they were? And you could see there's some error rate around that, right? I don't know what percentage it is, but something up here, something down here, something up here. There's some error rate around that longer term pin. And when you have shorter duration pins, especially gamma pins, then the error rate is very small. You tend to have very sharp turns on those gamma pins. But the longer ones you have are great because it really gives you opportunities, like especially down here and up here and up here, to ride some bigger waves down or bigger waves up. That's what I've noticed. Now again, it's an art, not a science, right? I'm not claiming that this works all the time, but it's worked very well in the past. But let's take a look here. So I saw this trade. I think it was the 14th, 15th. I can't remember. Let me see. I think it was here at the 12th. I have it on Twitter. It was like the day before it actually went down. Let me take a look here. It's there's Roblox, Amazon, Reddit. Here we go. It was the 14th. This was the 15th, but I placed the trade on the 14th. And so you can see here the old version of the site had these like white outlines on the largest ones, but I changed it to be color coded so it's easier to see. And if I do concentration, we could see that it's all sitting there. You see that? So the more, in this case, open interest there is, the wider the bar. That's what that concentration mode means. And if I go back in time here, Thinkorswim has this think back. You can go back in time. And I'm going to go to the 14th. And I fucked this one up. I did a 1-to-1 diagonal. And the next day it fell. And then I had to make it directional. So I had to buy back one of the things to take a loss. And then it went down again. Well, anyway, it was a very complicated position to manage. But I still made money. But I could have made a lot more money if I just did the trade correctly and just let it sit. So that's a lesson to learn there. So here we go. April. And this is at 220. And you could trade the 220s, right? But the delta here is a 20 delta, and probably get a little more lucrative play out of that. And then March, I did 220s. I did a 1-to-1 220. That's what I originally did. And so I'm going to show like a diagonal here. So let's see what's going on here. That should not be negative. Oh, there we go. That was a 1-to-1 diagonal. That's why. So here's a 2-to-1 diagonal, front month, back month, right? So we're buying the back month in April, selling the short month in March. Now, one way to do this as well is you want to trade this around a catalyst. Here, we have earnings on February 5th. At least that's what it says on there. And you could probably get away with selling. You can't on, it's the 6th. Never mind. I was going to say you could get kind of cheeky and try to collect credits before the event. That's very common. Like you collect credits before the earnings, and then you have an outright position with your long on a put or long on a call through the event, right? But in this case, it doesn't seem to matter. But here, so I'm a 2-to-1, and here, just doing one 2-to-1, it's a $4,780 profit. Look at that, at least till today. So that's just doing one contract, right? 1 2-to-1 spread. And if I go forward in time, you could see it just plowed through. Why? Because that volatility was compressed and it escalated. And so then you had this collapse through the spread. And your expectation is some consolidation around 115 with some error rate, right? You could see like it goes up, it goes down, it goes up, it goes down, it goes up. And it took a while. Look at that. It's like 3-4 months or something. And over here too, you see like there's some huge error rate going on here. But eventually it cracked. And that's just watching where we are in volatility land and working with that. So for example, if I get a big volatility move like this, all the way up to 28, 30, whatever it is, and I come down here, and we're sitting here, I don't know what date this was, somewhere in here, maybe down here. Let's see, let's get some actual dates here. So here's the volatility event, 1017. 1017 here, see that? Okay. When the volatility event comes, and we know that the event's going to end and we're going to get compression again, well, the price is going to rally back up into the pin. and then you get your volatility event, and then it compresses, it's going to rally back up into the pin, right? So you have to be aware that if you get this volatility event here, the move is most likely done, right? The move is most likely done. And then you can just watch how the price reacts when the market is up and volatility is down. And that's another thing to take note. But what you can do here is, now Carvana, I did something similar. Let's go back here. This was more of like just an event, a news event from Gotham Research about the fraud, right? And that kind of helped the trade. But I saw this spread here. This is an open interest spread, right? That was one. And at some point, a gamma kicked up right at the money. I can't remember what date it was. I think it was the next date. Yeah, here. I saw this gamma pin here and this short dated one here at 400. Now, what I've also noticed is this. It's not always the case, but it's kind of common. And it really only works when things are when things are trending like this, very aggressively. When things are trending aggressively like this, aggressively like this, aggressively like this. But when you're chopping, it doesn't always seem to be the case. But let me demonstrate. Is that you could see here that we have an offset of the gamma on different expirations. Now it's fairly close dated, and the close dated ones are they're typically hard to trade, but I could see, just look at the visuals. You could see it's here, this bar here. I'm not going to cover it, that one. You could see the price reacted downwards to there, and you could see down here the price reacted upwards. So I know it's being respected. Oops, sorry. I know it's being respected. And I know that there was that open interest. It was something like down here, right? That was the open interest spread over there. Okay, what I noticed is that when you have a longer dated gamma that's lower, and specifically if it's like way out here, not up front, and then you have an upfront gamma. I'll show you. Microsoft has this right now. I'll show you Microsoft. Okay. Gamma, here we go. You have this longer dated call, gamma, that's the largest one. And this upfront put gamma, which is short dated, that's in 2 days. What I've noticed is that this is directional. This is indicating directional downward movement. It's not support. I've never seen that before. And so you can see how it's offset, right? You have the upfront one will be directional, and the longer term one is just kind of what's driving it downwards, if you will. And there's other cases where you're going upwards and you have the short gamma, the gamma pin here and a longer pin over here, and it just drives it upwards. And more often than not, I don't look at that as support. Even though it could bounce, I just don't look at it as support. What I really try to find are those really big, juicy, long-term spreads here. These long-term spreads. Even look here. Look at this. Look at gamma. Look at gamma. Reddit. There's your long-term there, and there's your upfront short-term, and that's the directional play. So this is really driving all of the downward momentum. But we know that the long-term support in open interest, because that's where the open interest is sitting down here at 115. You can see it on the bar. It's over here, 115, 220. See that? And so this is the range. That's the expected range. Also, take a look at, does this drawing still work on here? Yeah. Take a look that the price is to the left of all the calls here. See that? It's to the left of the call distribution. And it almost rallied a little bit above, and then it sold off. See that? It hit the high, and then it just sold off. And so all of this is the dealer unwinding their positions, their hedges. So they hedged all of this, and they're unwinding it. And you go back here. So you could see there was a lot of hedging going on in here to the upside, and now they're unwinding their position. See that? So what I look for is, I like growth names, so I do over 1 billion. or it's actually 2 billion to 50 billion, but I just do 1 billion just to encompass everything on here. I don't do ETFs, the volatility is too low. And I do a gamma spread. This is what I do initially. And then I sort by delta as a percentage of float if I'm long, descending. And so these are the names that are going to have massive delta hedging requirements. See? And these charts tend to push upwards. You tend to see upward movement in these prices. And so that's what I'm looking for. Now make sure we got to be on gamma, because that's what the spread we looked for. So here, you see this short-term gamma, it's in 2 days. And look to the left, the price has just been chopping around there. So there's nothing really interesting in that trade, nothing interesting in this trade, nothing interesting. I wouldn't do that trade. Short term, wouldn't do that trade, wouldn't do that trade. So you see, like, let's think about this. If you have a distribution of equities and you take all of their returns, right? Let me draw here. And you plot them in a distribution, and you're going to create a curve if they're normally distributed, right? Okay. And you take all the returns. Well, you're really trying to trade the equities over here. This is your alpha, right? Maybe like 2 standard deviations plus, somewhere over there, right? This is all the alpha. This is where you want to trade. Now, it's okay if you get in a trade and you're in this range here. It's okay if you're in this range. You're still going to make money, and you probably make some good money. But you really want to just stay away from everything over here, right? I think that makes sense. Now, if you look at the totality of all the equities here, and there's 2,000 of them, well, the ones that are in this zone here are going to be few and far between. You're really not going to find those trades all the time, and that's okay. You know, as Stan Druckenmiller says, or Warren Buffett says, they both say the same thing, is that you just wait for the market. You just wait. You're not going to get penalized. There's no strikes, as Warren Buffett would say, and you just wait. You just got to be patient. And so when I'm looking through names, I'm looking for some really fat pitches, things that I can just look at. Let's talk about this too. So there's a lot of names that this is going to have a lot of delta. It's going to be all blue. Yeah, see that? And this is all the dealer hedging. They're hedging all of this. All of these calls they're hedging. You can see it over here on the bar chart. It's going to be all calls. See that? So the dealers, every time you get an uptick, they have to hedge all of this, right? So you're going to get some really dramatic movements there. But I don't chase those names. Those names eventually are going to rotate over and crash and burn. And I don't trade them to the downside. There's nothing indicating here that you should be trading these to the downside. So anyway, what I'm looking for is fat pitches. And I'm not sure how often they come. I'm trying to remember. I mean, if you get some really good high quality trades, all you need is 1 or 2 and it'll make your year. That's all you have to do. You don't have to be in all these different types of trades. You don't have to force trades. You don't have to, you just don't have to force anything. So let's talk about something like this, where you have this spread here. It's 37 DTE. Well, there's just not a lot of open interest here, right? It's very thin. And I just kind of avoid thinly traded options. I just stay away from it. They're just too hard to trade. They can rotate at any moment. They can squeeze at any moment. And it's not very indicative of price movement. Now, what I really want you to get used to is when you look at a chart, you're trying to look for a few things. One you're trying to look for is that you're trying to find where there's really no options below the support, and you have a ton of calls if to the upside. That's one thing you're looking for, and that the price is either below or consolidating on the bottom pin, while volatility is elevated. That's what you want. You want elevated volatility, general elevated market volatility, because when that compresses, the probability that the stock rises will be much higher because, well, puts tend to be more expensive than calls because of hedging requirements and things of this nature. Well, when volatility compresses, the price of puts goes down. And when the price of puts goes down, the deltas fall. And when the deltas fall, the dealer has to buy the stock. So that's why you're looking for those types of scenarios. Another thing to take note is look at the pins and go backwards. Look at this. You see that? You could see the price has just been trading within the range. You see? So take note of that when you look at a chart. And so that's what I'm looking at when I scroll down. I'm looking at if I have a lot of calls here, if I have a lot of range, if I have an opportunity set to really play here, right? And more often than not, you're not going to find these high quality ideas, but one of these times you're going to have something jump out at you that's just going to be so obvious and you're just going to make money. It's just high probability trading. Okay. There's another thing to take note of as well is you can look at the overall market. And for this, when you do something like the SPX, go to expirations, set it to 5%. That way you can zoom in on it just gets rid of the OHLC. It just gets rid of the historical price action. And then you can just look at the chart and look at gamma. You could see we're right in the middle of the calls that are sitting at 70.50 and the puts that are sitting at 6,800. And so when I go to SPX, let's go here. When you go to SPX, you could see I put here, actually I don't think it's delta, is it gamma? Yeah, it's gamma. So 70.50, the delta could be there too. Put gamma, okay. Oops, let's call. There we go. Now if I go back, is it call? Yes, calls, puts, 6,800. That's gamma. Let's look at delta, see if it's there too. Now that's good. Delta's going to be different because of how, if you look at the bars here, there's a lot of shorting of puts, selling of puts, sorry. It's probably going to be a big chart. Or maybe there is no delta profile. Hold on. There we go. Okay. Typically what you see, it's easier in open interest, my bad. Here, you see all of these puts here. These are, oops, sorry. Sorry about that. Sorry, my microphone fell over. I was trying to catch it. Hold on. There we go. More stable. It's a little rink-a-dink microphone. Okay. So you see these puts here. These are mostly sold. So the dealer is long these puts. And they're trying to collect income. These are income strategies. And so when you look at the indices like these, the dealer owns these. They're long these. They're not short these, right? Okay, so that's why when you go to something like pins and you're trying to look at deltas and things like this, well, it's going to be the inverse of a lot of the equities. Not sure what's going on here. Maybe people are using this site. I don't know. Okay, let's expand this a little more, see if we can find where that call is, 25%. It's going to be deep. Okay, it's deep in the money, and it's long term. It's March 20th. That's kind of interesting. March 20th, OPEX is when you tend to get a lot of volatility in the market the next day. It's kind of interesting. So you could see that this 7,000 is put delta. It's not called delta, it's put delta. So the price action is going to be very directional. If you get buying, it's going to go up. If you get buying, it's going to go down. But if it was called delta and gamma was sitting there, which it is, right? It's at 70.50. Yeah. Which it is, then what will happen is that as it pushes above this 70.50, the dealer's going to come in and sell. When it comes below, they're going to come in and buy, and vice versa. But the current range out till February 20th is 6,800 to 70.50. That's the range. And you can use this fairly aggressively. What I mean by this is, now this changed. It used to be 67.50 I believe it was, if I recall, used to be 6750 and 7000. I mean, let's go back and get the right data. Let's go back. Is that 1 month? Yeah. Okay, that's a tight range. Look at this. 6900, 6950. Look at that tight range for January 30th, right? And so once you have these ranges on, you could see that prices tend to rotate and bounce on those levels. And one way to see this is maybe like Google or something. And I showed like after hours, extended trading. Here we go. Okay. So here, if you go to Google, and I'm going to do historical because it's not an index. And that's back in time. And I'm going to go forward in time. Here we go. Okay, looks like the gamma changed in that. That's interesting. Let's go back. Let's go back. Okay, sorry. Here we go. Here's the spread. February 20th, right? So it's 310, 350. See that? And so the expectation is that 350, they're going to be sellers, and 310s, they're going to be buyers, right? And maybe I can get rid of some of the historical. There we go. And if I go here, look at what happened overnight on earnings. It went down to 310 here, went up to 350, went down to 310, it bounced, and then it faded all the way to 310, and it kind of just stopped there, right? That's it. It kind of just stopped. And the expectation would be if the market rallies, this would bounce. That'd be the expectations, right? It's an art, not a science. Remember that. And so that's what happened when I was up here. This generally has to do more with, and you can see here, like, here's the long term, here's the upfront. You see that? And so I tend to believe that that is the direction of the market. I don't know if that's true all the time, but that's what I've noticed. You find the long term and the short term, and you tend to get the directionality of it, right? And it hit it, and then it rotated, right? It went right through that original pin, and it bounced on it. But I try to look at that as well, but it's not as powerful. All right, so let me go back. We have our screener here. We did our gamma spreads. We have our delta as a percentage of float. And let me rerun this. So you could rerun it, just hold control and click the arrow and it reruns it. So delta is a percentage of float and descending. And we can even do like market cap just to see the big boys if they're in here. So Meta has one. See there? Meta has one for the 20th. Right? So it's 700, 645. Sometimes with these, you got to do the expiration view. So you can kind of get in here and zoom in. 645, 700. And usually when I see something like this, I'll just head over to the chart session, do this, and I put that on here. What was it? Was it 700? I can't remember. Oh, get out of the way. 700, 645. So there's 700, and there's 645 right there. And this is the put gamma. I'm assuming. Is that what it was? Call gamma. Yep. Okay, and so that's the range. That's the expected range. And you can see it was above, and now here they become sellers, and now they're probably going to become buyers up to 700. And so I just put those ranges on there whenever I see something like that. And that works well because what tends to happen, what I've noticed, is that in the S&P 500, if you're just watching intraday and you see these types of moves like this, and they're just moving up and up and up and up and up, and you look at the big mag names, mag 7, mag 8, whatever, and then you're like, oh, what's moving it? And I go to Meta, and I see that, oh, it's bouncing, or I go to Google, and I see, oh, look, it's bouncing off the 310. And when I see that, you could probably place some short-term trades to the upside because the dealer is most likely using that name to collect the premiums and indices. I don't know. That's a theory. I don't know if that's true, but I've noticed that very strongly, especially like on earnings on Google. the market was down bad, but Google is what saved the market because it was below the 310 pin and started to rally through it, like 7% or something, whatever it was. It was 8%. So that's another thing to note. I usually put those when I see them, and things like that. You see, I had it on Apple. It's like 280. I guess it's gone. Nvidia's 200, 180, 200. See there? 180, 200. And you can see above, they sell. Below, they buy. Below, they buy. Below, they buy. You see that? And if you go to Nvidia, is it still there? Well, let me do another one here. MOA, Nvidia. Okay, it's slightly moved. It's now 195, 175. So this is 175. So it's slightly moved. That makes sense. That's much better. And you can see there's upfront. So my expectation is it's pushing slightly upwards. It doesn't mean it's going to go there, but it's pushing slightly upwards. And if I go back, we could probably see the 200 there. Let me go back. Ah, here's an example. Look, see? It's not a science. See that? Boom. See? It did bounce on that level. So, again, it's a science. Is it open interest? Where is it? Hold on. Where did I put... Was it delta? What is it? No, it's not delta. Where did I get that spread from? Maybe it wasn't a spread that I put. Maybe I was just marking the levels. Usually when it's a spread, I mark the level, but it looks like this wasn't a spread. I just saw this upfront 170, and then I put the 200 there. That's what I did. So that's what... Okay, it wasn't a spread. All right, usually when it's not a spread, I don't put it, but... anyway, but when I see something like this, I'm not interested. I don't trade those, right? I like, Reddit. LVS was interesting. TMC was one. I'm trying to give examples of, kind of the ideas. Now, my strategy was kind of different back here than it was now. But look, here's an example. You see all of the calls here? This is gamma, by the way. That's gamma. It's not even delta. Let's look at open interest. Okay, just when you see this orphan thing down here, you could just ignore it. This big open interest down here, usually it's just people selling the puts. It's not indicative of going lower. It's just people selling the puts. That might be an artifact. What is that? 50 cents. Oh, it's probably not even on the bar. No, it is. Oh, sorry. So yes. So this is by expiration. So on this expiration of January 16th, that's where all the largest puts are. And it's tiny. It's 95.90. It's pretty tiny. But you see all this open interest and there's just nothing down here. That's fantastic. Like when you see that, that's really good. Look at VIX. It's elevated. You see? You see the elevation of VIX? We already had a move here and we had a move here. And it's starting to rotate lower. Yeah, see here? Like these artifacts. You'll get those artifacts because it's blocking it by expiration and then measuring it by expiration. So then you get like these weird big things up there. Maybe I'll fix that in the future. But look, elevated volatility and then compression. And once you start getting that compression, you're looking for upward movement. Now, where's the target? Well, probably $10 because there's really strong calls sitting there, right? Another thing you could do is, instead of looking at a strike view, you can look at per expiration view. And that breaks everything down per expiration, not per strike. And you can get some ideas there, but I tend to not look at that too much. Overall, it's just going to give you like the net effect of everything. And so it's really just going to pinpoint where the largest call and largest put is, right? But I tend to just do strike because it gives a better view of, directionality. Okay, so something like this, vol is elevated, we expect it to compress, it's bounced here before, you had some squeeze before, and target $10. And so I made 440% on the shorter dated December, and then and January I made 220% on this. So these are really good ideas as well. You don't necessarily need that gamma spread or things like that, or the delta spread. You don't need those types of things when you see a lot of open interest like this. And so I'll just go forward in time. Eventually, look, it hit 10. Ding, it hit 10 right there, and then rotated. So it only took about a month and a half, but we saw it down here, right here, right? And then you had a big move up here, a few bucks, some consolidation, and then after OPEX, January 20th, that's OPEX. After OPEX, you got another push higher to 10, and then we finally get a rotation. So things like that, when you see a lot of overhead calls and things like that when volatility is elevated, those are really good ideas as well. METC was another one, but not as powerful, right? This one I got in back over here and kind of sat through this little push down here when volatility was compressing. But see here, look. You see this long-term spread? I really like those ones. That's what I try to find. Now, I don't know if it was gamma at the time. Yeah, it's not going to be gamma. It's a delta. Okay, it's delta. Okay, there's a lot of delta there. But I usually do start with open interest to see where the spread is. And remember, volatility was elevated here and it started to compress. This is when volatility was compressing from its high. Yeah, see, its high is starting to compress. And then now, typically what I've seen is that when you have elevated volatility and then it compresses and compresses and compresses and compresses, and your stock isn't responding and it's falling, it's technically a really bad idea. That's what I've seen before. It's not always true, but when volatility is compressing and your stock just keeps going down and down and down, that's really bad. It's very rare to see rotations like this. But METC did rotate, thankfully. A little bit of luck. Sometimes that's what you need. And this one, I was trading up to 25 bucks, not to the 30 range. I was trying to capture just some short-term movements here. And this one worked well. It made 85%. It didn't do as well, but eventually, because, I had it like January. I had it short-dated over here on the 20th, this date here. But I closed it on the 16th. Made 85%. Wasn't the best trade, but it was okay. But after OPEX, it almost pushed up to that 30, and then it rotated, just like TMC did. We had some volatility come into the market, right? Now, I'm still looking at that, right? Like I still have it on my watch list at 15 bucks, somewhere below there. So anyway, that's what I'm doing. Hopefully, like this can help you guys find ideas where you just look for long-term spreads. Yeah, see here, see this one? Like there's this orphan thing that sticks out all the time because there's just a shitload of options there on that expiration, and it kind of skews things. But maybe I'll fix that by doing a cutoff or something. I don't know. Yeah. So anyway, look for spreads, see where we are with the overall general market volatility, and try to place your trades above or below those spreads when you think you're going to get rotations in that vol. If you're really elevated and you think volatility has been compressed for a very long time and you expect volatility to come in, play it to the downside. If volatility is incredibly elevated and you expect compression, you want to buy below this, especially if there's been consolidation around that level, right? You're probably going to be in a lot of put territory and you're going to be in a lot of call territory. It's a reversal trade, right? Now, when I see stuff like this, where you have a big spread and the price isn't close to any of them, it's a 50-50 trade. The stock can go up, it can go down. And it's mostly driven by wherever the gamma is sitting, because that's how dealers are hedging gamma. So you can see the spread is actually 940, 1,000. And it almost is forming some type of consolidation range here. But that's currently like what the expectation is. But when I see open interest this wide, it's just a coin flip. You're sitting right in the middle. Look, you're sitting right in the middle of everything. See? Well, middle would probably be down here, but you're in the middle of this call distribution here, and you're on the right side of the puts. So it's not necessarily right in the middle. Middle will probably be down here. But you tend to be in the middle when you're in this like middle. See right here, like you're in the middle between this one and this one, and it's 50-50. Like who knows where it's going to go? Who knows where that's going to go? Nobody knows, right? Man, Planeteer has been getting smacked. That looks like a short still. Okay, see, Goldman Sachs has this open interest here at 1,000, right? So maybe that's a short-term target. Here comes IBM. Now, you do have to take into account a few things. Just because a price is pulling below her, like it's going to come down here at this open interest, but where's Gamma? Is Gamma there? Okay, it is there. So maybe if this maintains here, maybe you're thinking about a trade, because this is out till March. That's a month. I don't know if you guys, that's kind of short term. I don't know if you guys would trade that or not. I wouldn't, but that's an idea, right? If price comes down below this 265 and volatility is elevated, right? But volatility has been compressing in the last few days, right? Like look at vol here. It's been compressing the last few days. It's still trending upwards. By the way, I think this moved to 18. Yeah. Volatility is moving upwards. It's compressing a bit, but look at the price action. If they just had earnings, see that? They had earnings. It gapped up and it's rotating over with compression of vol. So you got to be careful with those types of names at this support. You just have to watch price action, right? What you would expect it is that earnings are good, the price is up, volatility compresses, the stock continues to push higher, but it's not. And so on good news, look, that's a top and bottom beat, and the stock went down with volatility compressing. That's not a good sign, okay? So just be aware of that when you're trying to find spreads, that you're looking at price action, confirming it with overall market movements and volatility, and seeing if it makes sense. The news is really good and the stock is down, and volatility is compressing and it's still down. So when if volatility ever escalates higher, it's going to go down more, right? It's just obvious. So just make sure you have those in the back of your head where you're taking price action into account with overall market volatility. And what I'll tend to do is, like, if I find some interesting trades, I'll definitely post about the trades and kind of give a walkthrough of what I'm seeing. But remember, more often than not, you're trying to find the trades that are on the right side of the return profile. And out of 795 stocks in this group, there's probably only going to be 1 or 2 or 3, even if that, right? And trying to find those is kind of difficult. I just kind of put the scanner on, rotate. I look at market cap, and I try to find longer term spreads. Maybe that's what I'll do. Maybe on the options here, I'll put spread term or something like that, right? Maybe greater than 60 DTE, greater than 90 DTE, greater than 120 DTE, something like that, right? And maybe that'll help isolate, what's showing up. Maybe that'll work. Maybe I'll do that. That's a good idea. Hey, thanks for the idea, guys. So, open interest would show up here for Reddit. See that spread? Fantastic. And but that's all I wanted to go over, and I'll keep making more videos and going over trade ideas. But right now, I don't have much positioning on. I have my Google, which up here I shorted. It was up here I shorted. They had earnings. It came down to the 310. I have this. They're outrights. There's 4 at 914 and 10 at 1263. I think that's in April. Yeah, April, June. June is 10, and the April is 4. Now, I know the gamma range is here. That's the gamma range. And so what I'm going to be watching is, I'm going to stick on some moving averages, is that if price pushes up here, I know it's going to respect that 310, and it's respecting this moving average, which all the moving average monkey guys play with. And remember, it's not about where you, well, how am I trying to say this? It's not about what you think. It's what the dealer has to do, and it's what other people are doing. If everyone else is buying Google and the dealer's buying Google, it doesn't matter if you think it's going down. It's going to go up, right? So it really, quote unquote, doesn't matter what you think. It matters what everyone else thinks. And if people are losing money, they're going to sell. And that's maybe where the put comes into play. But what I can do here is an interesting strategy where if I have confidence that this 310 pin, this gamma pin is going to hold and it's going to rally, what I can do, so here's my trade. It's already on. See that? And so what I can do is I could come in here and, okay, February 20th is in, what, a week or so? Something like that, right? Go to February 20th. Look at the 300s. It's 211, right? So I'm going to sell some of these. And they're at 300 because, I can't short a 310. It's not allowed. I only have level 3. You don't need anything higher. But, because I only have spreads, right? That's level 3. But here, I can maybe short, well, it's 14. Maybe I could short half, 7. And so it'd be a 2-to-1 diagonal where I have back months and I have a front month. And I'm going to sell the 300s. So here, I would come in. So this is kind of like active risk management. It's probably a little bit over trading for my style, but it's a strategy. That's for sure. So February 20th there, and this would be -7 at 2.11 there, right? So what is that? $1,400 or something like that? So I'm going to sell 7 of them here, anticipating that in 1 week's time that this pin will be respected and you'll just get a rally and consolidation somewhere in here. You'll collect your $2.11, which is going to knock off your entry price on some of these, right? I don't know what the math is. Well, if you took 4 and you took 211 off, it's going to reduce this April entry fairly significantly, right? And so what you're doing is you're collecting credits along the way, and what you're really targeting are news events or volatility profiles where you're directional through the event, right? And LVS was kind of an example here where I shorted up here the 55s, and they were longer term, they're like Aprils, and I shorted the Januaries. And so as the price came down, I collected the Januaries on 120, and then I was directional through earnings here, and then earnings came through like this. I was directional, and I made money. I just closed the trade. 100-something%. I just closed the trade. So you see that? Now I could have came in here and excuse me. I could have came in here and shorted March 50s, for example, right? And collected credits in March, and then had a whole month left over to maybe potentially push lower, right? So that's the trade, is that it's almost like a combination of a directional trader during events and a theta income strategy in the meantime on big moves that are directional to your trade. Another one is Carvana. So Carvana, I shorted outright. Well, it was a 4-to-1. Then I pulled off those 5 contracts, and I ended up with 15 at 2067 at 400. And there were $20.67 each. It's like $31,000. And we had the big movement, and we've been bouncing on. There was a gamma pin that was sitting in here, and we just kept bouncing on that pin. And it was around 400. It changed to 385, then went to 400. It's somewhere in there. Well, it was a 430, 420. Let's just look at it rather than guessing. Let me show you. Let's go back here. Okay, here. It was 400, 425, and then I hit next. See, and it went to 425, and it was above it, and then it sold down back to that pin, right? And then it bounced on that pin temporarily, and okay, now it's moving lower, and everything moved lower, you see? Now, when you have really tight gamma pins like that, it's really hard to know the directionality of things. It's really hard because it's going to be very directional. It's either going to go really up or just really down. And it just depends on the flow of options, the flow of buying or selling. It's hard to know. It's very directional. Okay, and so see the gamma pins there. Okay, now some gamma pins are lower there. Okay, now we push down. It's still there. And we push down through it. You see that? Like, look at that. You see the pin there is at 350. And we step over. Boom. Look at that. We hit it. 350. And it bounced. And now the gamma pin is 380, 300. And that's on earnings. Right? So my bet is on earnings, we either go to 380 or we go to 300. That's it. That's the bet. Right? So what I did is volatility doubled. Actually, I think it went more than double, if I recall. But up here, through this downward movement here, I shorted 10 of them for March for $41. So I made, what is that, 10 grand, 11 grand? 10,500, something like that. I made $10,500 on the trade already. I pulled all my money out. I already made money. And so the trade is free. Take a look. Look at this. $10,414. That's what I made on the trade. And it's free. The trade is free now. So I have 5 outright. And it's at 350, something like that, right? It's right here. I'm up $56,000. And if earnings comes out and goes to the 300 pin, let's just assume, who knows? Well, I make $15,000 more dollars, right? So my short, I mean, it matters and it doesn't. What could matter is, let's say they have earnings and it rallies above 400 and it sits there above March. Well, I just collect all the credits and then it becomes this trade. I still have my 15 for April, right? And when I have my 15 for April, what I could do is I could come in here, go to April, and I know I'm short at 400, right? Here's my position there. Well, I could just short 250s like this. And so I can convert it to a put spread, right? It's the same expiration, different strikes. So it'd be a put spread. And I'll sell 15 like that. And now it's a put spread, right? So I'm going to pull 15 times 13 times 100. I could pull another 19,500 out of it, right? Because that's going to be credited to my account. And if things pop off and it tanks through March through April, this is assuming it's above 400 after March, right? And then it tanks after that, I can make $213,000. So this is a fantastic strategy when you know where all of these gamma pins are and how to use credits around those levels. And it works out very, 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 very well, right? So this trade right now is up 500% because I've already pulled all my money out and I'm making money as it goes down. It's up 500%. It's a free trade. It's probably infinite, but but that's what I look for, right? And I guess that's all I have right now. But what I'm trying to say is that if I find some interesting trades, I'll definitely make videos about them and talk through what I'm finding and how I'm positioning the trades. And hopefully you find that interesting. And thanks for listening. You could sign up for a Mountain of Alpha for free. And make sure to like and subscribe. Thanks all.